Hey guys, how are you? Been a while since I spoke on metals, precious metals that is. We start with gold. Let's get straight on with it. Market Sniper, going to ask you to hit that like button and give me one share right now. Use the share arrow. Also check, subscribe, and always you are being unsubscribed from this channel. Okay, many people reporting unsubscribes from the channel. Okay, we called this big bull market while the oil was being slammed, and in fact gold, it was in such a bull market that the COVID events that brought it down then brought it straight back up, small little hiccup, little flag, and up it went into its final target. That performed also on the euro and the pound. What are we doing right now? Well, it's an interesting one. So we've said many times the 1680 level is a particularly significant level. The 1680 level is a particularly significant level for a number of reasons. I'll take you into that again. But I'm also going to highlight that you also have some risk of double top. The secondary high was not quite as high. It went in and around the 2078 mark, while up top here on the blow off here 2089. But in terms of technical patterns, there's some risk that it could also be a double top. So we're in a situation, an interesting situation, where right now the dollar is actually easing back. I don't think that lasts forever, however. I don't feel that lasts forever. Also, we are seeing the 10-year treasuries potentially reverse, possibly all the way back down to 2%. So if that were to happen, could it be fear? Could the dollar actually be strong on fear as money runs back into the bond markets? Is it automatically going to be strong for gold and risk on assets like equities, Bitcoin, and gold and silver? Again, gold and silver is more than just a risk on assets. It's real insurance against system failure, in my opinion. But it does do less well when the dollar is strong. That's understood. And during this period, of course, we had a 6 or 7 million trillion print in reaction to COVID that took this up to and beyond the 2000 mark that saw your 2089 be run on the dollar side. So technically in patterns, I'm using logarithmic scale and I'm highlighting that a 1360 move, roughly 23.5 move. And this was quite an interesting level, by the way. It did trim a few highs here. So I'm going to keep that 1360 in there for a bit. There were some interesting HVF structures in there that started the whole move. Let's just keep it 60. So you're trimming the tops of that. It was kind of a resistance, but it would also be the downside target if this turned into a double top. And now, again, I'm a massive fan of metals. In fact, I'm a big investor. But I want to highlight that if we were to have the ultimate crash, bang, recession, dramas, we could, in fact, still see the paper price of gold go down. So there's your M top. You're getting a nice rally now at the 1680 so far. Don't forget you were resisted at the 2075s in both instances, 2089, 2078, back down. So this particular level is significant for a number of reasons. Let's break it down. Let's drop a few time frames for the gold so that you can spot it. In fact, I might even go all the way to the daily and just highlight this in a little bit more of a compressed fashion. So here's where essentially you dipped one small amount, you dipped a big amount, and then you dipped a small amount, all with the resistance at the 1680 mark. So let's just highlight this. And this was all around the macro events that we've already described. That was March 2020 pandemic. So there, first meet of the 1680, down. Second meet, that was the main crash. Third meet, and actually you broke on up. Now, we would normally categorize this as highly ascending. We do not subscribe to head and shoulder continuation patterns. Head and shoulders are reversal patterns, despite what Peter Brunt and various authors have written. You went in and you were supported here, 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 and here. That was all flags. So this is quite easily justifiable as an ascending triangle with a top as an upside move. Anyway, so it went into a flag once you were on 1680, so you got support there, you got support after a number of times of resistance, support, and support. So that's already created a massive level of great significance in the 1680. However, that's not even the beginning of it all, because again, we clear and we pull into the future and we go back forward. So that was the most seminal event of the last 2-3 years was the closing down of all of the SME market, etc. And let's go 2 days and squeeze it on, shall we? And get it all on in one view. Let's see if we can do that. Steal a bit of real estate here. So there you go. Now you're seeing it all. So where other points were you? Well, you had a double bottom on here that made its upside target. We also saw and called that 2 more 1680 interactions. Boom, boom. And then again, a spiller, an absolute thriller that spiked away. And then you kissed the bagel and you came and you've done a hammer again here on the 1680. That's countless reference points to the 1680. So it's going to take something big to make it go back through that. Now, it was in a bull market when it ran up to that 1680 back in the March 2020 period. But we could have such fear and loathing created that there is a potential M for the paper price. I continue to make that clear distinction. And this is your best insurance against system failure, and system failure is assured. But during this period, when they create fear, maybe we run USD Treasury back down to 2% on a head and shoulders reversal. I'll show you that in a minute. That could be a lot of fear. It could be full-blown monkeypox. There'll be silver backing the story up and down the coast. And who knows? So this could be China, Taiwan war, Asia crisis. We've been talking about an Asian FX crisis for an extended period. We've referred to the Korean won. We told you how much the yen has done, going from 107 to 138, currently in pullback. We've continued to say that we expect the Korean won to break up. We've also pointed out that the Hong Kong dollar hedge is not going to hold. Peg is not going to hold forever, and we actually think there's chances that this thing's going to be allowed to go. Why? Because China's in trouble. China's not going to bail them out. Hong Kong is being subsumed by China. Guess what? Why would you want to do an IPO listing that will actually see you fall under communist rule? People are being picked up out of Hong Kong and dragged off to Beijing. So in essence, this little corner of capitalism is slowly being subsumed by the tide of Bolshevik communism that is the China ploy, and their dominance is going to be they're going to assert it over Hong Kong in time. So they're going to lose their revenue. They're going to burn up their reserves. Some say they have a lot of reserves. Well, when you can count the inevitable coming, sometimes it's smart to jump before you get pushed, and you get to hold some of your cash. But anyway, we'll see on all of that. So whilst this isn't a nice uptick and will be giving some respite to metals bulls, I want to just caution that there's potentially a much bigger hit coming our way. And this is exactly what I also get with the crypto guys. I think, it's all back on, everything is hunky-dory, stock market up, etc., etc. The redefinition of recession is for a reason. They don't want to cut rates. They want to continue to tighten. And as a result, they will seek to get the dollar reasserting in strength again, and that's going to be fatal for pegs in a number of places, not just Hong Kong dollar, possibly Saudi, etc., etc., etc. Anyone who's thinking of forming a rival to the dollar is going to face dollar strength, and they never needed to show strength and to face off rivals on the same scale as currently happening. So that's the technicals on gold. Good for now. Don't lose your head about this. Don't lose your head. And remember, we were the bull from way down there, sub £1,000 and in and around the 1250, 1300 mark on this falling wedge. Take the falling wedge breakout and hold it through for the 2000 run, whilst being very bearish on oil at the same time and calling for a single digits. Since then, you can see we've actually been in a range of 1680. That was the ledge you jumped up on post-COVID. And so whatted it, and then you took the trillions, and then since then you've actually been in this ledge. And I want to say, without a squeeze in this, it's concerning. It could be a top, could be. That doesn't mean I am calling 100% officially this is a double top. I'm just warning that there is the likelihood of very big downside risk that the paper price could trade this low. Should you be accumulating into this? Yes. But could you have all sorts of other financial challenges that makes it more difficult for you to accumulate at that time? Yes. In the same way, people are finding it harder to pull the trigger on Bitcoin at 23K than they did at 60K and going up. So that's kind of the situation. That's kind of a warning. However, not every time that you do touches like this, you could do a triple and go back up to this level again. And pull down. Ledgers can break to the upside as well. It doesn't necessarily mean that, but generally they're not typical continuations, and normally you would have some kind of broadening structure with a downside lean. Note how we pointed out here that you had a broadening structure with a downside lean, and we wanted to see this broken. That meant you squared up and you stopped going in this mean reversion here of downside gradient. You squared up here, and then you actually had a little bit of a run where you went up there, but this led to a broadening structure across here, which you have to then break through to the downside, and you got that tiny little fractal, bit of an inverted HVF, in fact. There you go, squeezy Japanesey against the bagel, a real fractal against the basing ascending grind line that started at the double bottom here on your 1680 and ran across through there. So that gave you this little wind up for the dip to the downside. Is this a return move, or are you going to probably range trade a little bit more here, and or in time, if the fear comes back, you could return to the bagel, but you could end up being back down at the 1680 again, and then zigging and zagging, and then having a tough time on terrible news. That could happen. There's some dark winter awaiting the Northern Hemisphere, and I mean dark in a number of ways, and I don't think this is going to be broadly supportive for the global economy. I truly don't. I really still continue to warn that the risks are to the downside with the paper gold price, and that doesn't change that much when we talk to our little sister in the silver outfit as well. So let's pivot across there and say hi to her. So how's the silver story narrative gone? Very, very similar. In fact, let's go through this chart again on the bigger time frames as well. This was the same story. Your COVID levels were around about the 1850. This should be 18 and a half. So you can see again, in the same way as gold, sort of the first knockback, then the major event with the lockdowns, and then a tiny knockback, and then you blew off and you popped right up to here. And in fact, you superseded it with the Wall Street silver hype there. This generally could be a broadening structure, but it could also, you could also spill through it. It's not too strong to say this is all going to be one macro upside continuation. You could see the role that the $22 played. The $22 silver is very much like the 1680 gold. Here, and here. Where did this $22 come from? By the way, the 18.5 was the COVID level. On gold, the COVID level is the 1680 up top there. Here, your COVID level was lower and you bounced here. So it's interesting that in actual fact, in both cases, on your COVID level, your resistance that you failed to hold above, $18.50 on silver and 1680 on gold, you have revisited that level. And for now, that doesn't mean forever, it is currently served as a point of support. Remember, Dixie is down from 109 and sitting in around 105s. That's with the dollar backing off. That is with the dollar backing off after the euro ran parity and did exactly what we expected it to do, to have that wee rally, which is exactly what's gone on. So in both cases, yes, whilst the dollar is pulling back, gold goes up, Bitcoin might go up, stock market might go up. But I want to caution to everybody, the main event is yet to come. You're going into a very dark and dangerous winter. Fear will be their primary product that they will market. It is usually their primary product, and on this scale, they have set the scene to take you on in more ways than you realize, including absence of heat, absence of light, absence of all forms of grid support that could have all forms of repercussion for manufacturing, business, your ability to get to work, etc., especially if you're traveling on electric trains. Or charging cars. You could be restricted from consuming energy at various times of the day by various amounts. All forms of load shedding could become the new norm for nations that have never had to experience this. So a warning. Contraction. What happens in contraction? Things that are liquid get sold. Simple as that. Bitcoin, silver, and gold. Paper prices, and the smart accumulate into that weakness, particularly in the case of silver and gold. But it's not overall a positive short-term outcome until the great solution comes into town, which will probably be your central bank digital currencies after a lot of pain and suffrage for most and many. So let's have a look at that weekly. Where did that 22 also come from? Let's also just remind you, a long time ago, You have a number of levels that are key on silver. The 28 we've highlighted here that you are bumping into and didn't run through was the base of that descending triangle there. That was run here with the base of it along there, and the 28 took most of those bottoms, clipped the bottoms there, and is turned into resistance here. So you are actually in an entrapment area. I'm going to move that 22 line a little bit further to the right over here, because that was when you kind of blew off. We'll set it exactly to 22 to not upset anybody's OCD, especially mine, through to the 28. So that was when you properly started to melt off. You could argue that it even came a little earlier, in and around as you were approaching 20. Run, superpower. You broke back down through it, you bounced, and you go. That is your 28. That is your 22. So actually, this move up, which has been the gold new highs, silver has not responded as far yet. And it's run into the 28, failed a couple of times at the 28, I think tapping out at 30 on the highest part, the Wall Street. That's a wick only on the monthly chart. So your highest monthly close actually seems somewhere around here at 28.6. And now you are holding between 28 and 22, which was your blow-off event that took you through the top, and then you broke down through. And since then, this was all a big basing out, and then you took back up. This right now is a bit of a hammer. So the expectation will be a bit of an upside move, and that's why I've drawn this broadening structure as a potential longer run continuation event over here. So it is likely short term that will continue, but how far and for how long is going to depend on strength of the dollar, in my opinion, and fear. And the fear index, one of the best things for you to watch over there is going to turn out to be the debt markets. So I've highlighted this before, and let's just get it up. We're talking not the equity markets, of course. We're talking the debt markets. Here we go. Here comes the 10-year, one of the classics. A lot of annotations there. Shooting star pullback. So this is a very heavy clustered area. The threes. The 3%ers. So we've highlighted where the 3% mark is. We've highlighted this whole move. This was all an inverted HVF. That was all part of the 2008, 9, 10, and then this super stimulatory interest rate environment that had an absolute dip to negative, virtually negative 0.3 down here, and then spat back up to get over here. All of this is absolute. You're living on oxygen and O2. You're carrying your canister around with you. You're a sick old man. And this is kind of where we've been. I'm going to drop into the lower time frame so you can just see what's gone on the shorter time frames with all these annotations. There is a possibility that you are in a head and shoulder. We highlighted this with this first touch over here. You are already lower since then. And we've suggested when you are still in the 2.8s that there might be a chance you run to the 2s. All the way down to the 2s. That's right, the terrible 2s, which would be a target. Geometrically, that's a geometric target, not a logarithmic one. From here, and even if you took a percentage-based one, you could still fall pretty far. You could go to the 2.1s. So I'll put that in there as a log-based one. Geometrically, we're looking at a possible 2. And you are skidding. In other words, there is fear coming in. And how long do you think equities go on up in a fear-based environment? I don't know. If the people are behaving like there's QE already and there isn't. The only environment where all things go up is a quantitative easing environment. It's rare that you see bonds going up in value and yields going down. And you also see the stock market pumping, and you also see Bitcoin pumping, and you see all risk-on pumps. That is generally peak liquidity. At the moment, you just had 3 interest rate hikes and a tightening of liquidity in America. And you're starting to see interest rates. You had a 0.5 in Europe, which is still absolutely insufficient and negligible for their level of inflation. But nonetheless, the movement direction and the trend is towards that. So people are already assuming that things are broken because you had a recession. Only it's not a recession because definition suddenly changed because we don't like that. Why did they do that? Because they want to turn the pain up more before they do what they would normally do in a recession, which is reduce, certainly not continue increasing rates. They want to keep increasing rates. And they're going to do it in the name of inflation, but also to the strength of the dollar. This is going to precipitate an Asian FX crisis, and it will bring the euro substantially down, in my view. So when we look at this debt market and this reversal, this isn't positivity for risk on assets, in my view. unless there was QE around, the rest of the things don't go up when bonds are being bought up. That's my take. The rest of the things don't go up when bonds are going up. Because it's when you're getting a better yield, generally, if it's a bullish market, you buy equities. They go up more. But valuations are ridiculous. They're ridiculous also on debt, by the way. There's too much of it. It's hyper overvalued. But it's the safety trade. Okay, so that's a little bit about the 10-year and the fact that we expect this to be slipping off, at least to possibly the 2.17s, possibly 2s, which could mean a run 1.9s, 1.95s or something like that, which is points to fear. Points to fear. So paper price of liquid items like gold and silver could in fact indeed go down. Don't forget, gold goes up on the Asian session most times and is sold off in the American session. You've got to ask why. Well, the same people that are manipulating the debt markets and keeping it full value, the banking cartel, are probably suppressing the canary in the mine that tells you that this is a crazy ass economic situation that cannot continue for that long, for which all the rivets are popping in this submarine with the pressure, with how deep we have gone into the debt trap game. Okay, so that's a couple of thoughts on gold and silver. Paper price could go, in fact, down in an environment where fear is likely to come in. You're going into a northern hemisphere winter soon. There is already concern surrounding a lot of things, energy and supply chain. Never mind the supply chain on food, basics, etc. Maslow's hierarchy of needs. We're going to be talking far less about your Porsche Cabriolet and far more about shelter, food, reset, real functional base level needs for survival. With that in mind, we can confirm that high yield debt is also starting to recover a little bit. I wouldn't be touching any of that. We are currently short. That's our book, and we will remain short. You'll see it there and there as well. We can revisit the TLT, which is the long term. Let's get it back up. If the computer does compute, let's do it. 20-year long-term bonds market. It's kind of in a sketchy recovery of rally sorts. Had a little bit of a wind up over here. Whoops, there we go. It shows its face eventually. Don't forget, we've had this call that this is in a head and shoulders to the downside. We can quickly highlight that neckline, and you've been going down. Let's take those lines off. A little bit of a bid here because you've come to legacy lows. Left shoulder, a little bit of a teensy-weensy left shoulder blow up. A spike of mentals for the head, then a pullback, right shoulder, and then off you go. Nice projection, down. So you're getting a bit of a bid now. Again, a little bit of a rally and a bid in the long-term debt. That will go along with the possibility of a reversal to the lower twos. You could even get a neckline revisit. But any further churning here, long-term for us, this was the all-time highs for the value of TLT. Do not buy bonds. Do not expect to wear diamonds if you do. In my opinion, this is reset. The next major stage in reset is to destroy debt. That's how they will push you, destroy your pensions, destroy most of your money system, thereby forcing you to move into the new money system that they have intended for you all this time. Yes. Okay. So we continue to hold these views. How do we be wrong? Well, this rallies, cancels this high and comes somewhere strongly up past the neckline, cancels the right shoulder on the debt market, and debt markets are doing really phenomenally, and then winds up for going to new all-time highs like this. Everybody thinks bonds is the best thing in the world, even though you're losing money in the relative inflation game. So everyone would have to become major buyers of bonds on a sustained basis. That does not tie in with QE because people will chase risk. Nobody wants to buy something that's guaranteed to lose you rates, where you would be being paid 2% in an environment where inflation is actually 9-10% officially, and probably closer to 16-20% unofficially. So Why would the bond market suddenly show such strength? It's at the end of its tether, in our opinion, but we could be wrong. The Dixie, as we've highlighted, if you look on the bigger time frame, that's a bit of a shooting star. It's quite a wick pullback. You're at 109s over there, and now you've pulled back. But this has been an absolutely stormer. It's been driven by weakness of the yen and weakness of the euro, the two main components, but also weakness of the pound, which is in the mix, and that probably does for about 80% of the constituents of the Dixie versus the dollar. So, wow, all those currencies, they've just done terribly, and as a result, dollar has benefited from that. But this has been blow-off strong. I mean, there's literally no major, from this low here, there are no major red candles of any significance. This is literally not much more than a spinning top. So is that. So is that. This was a moderate one, just as you were about to take the H2 high and the H1 high. You had a moderately large one. Everything in between, since there, green, 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 spinning top, green, mega green, strong green with reversal, probably a shooting star. How far back with a reversal like that do you pull? Maybe to the tops of this, which were previous legacy highs of H2 and H3, that range somewhere between 103. You could drop to 102s through to 103s, but that means you're expecting the euro to be doing well as a currency, and the yen, that is doing yield curve control and printing itself, to do well as a currency. I would argue that's one heck of an ask. Okay, so precious metals, paper price, in an environment where bonds start to do really well and rates come down, I would call that a fear risk-off environment. Could it be a risk-on environment and bonds go up, equities go up, gold goes up, everything goes up? It turns into a flagrant bull market, everything up for most things. The only way is with QE done. But everyone is behaving like the QE is already here, and they're going to get a shock. The Fed's going to keep the pain. They aren't going to give you your heroin and morphine and your lovely painkillers to make you feel high and cool. They are saying it's not even a recession. You aren't even hurting yet. There's a red hot labor market, they tell you, for pizza delivery boys. So that's the game. That's pretty much the game. Energies, key important point on this, which is a massive aspect of inflation. Despite the shooting star there, you haven't gone and collapsed down somewhere here. You bounced a little bit, failed to make a new high, and now you're hammering here. It's really hard to hold the combination of WTI and Brent, and I always average them out below $100, because you've got WTI at over 98 and you've got Brent at going on 104. You're actually averaging around about our 102, 101s, 102 on the two of them. Most of what Europe needs is Brent. So it's going to be really expensive. And as for natural gas and what the Germans are now paying on natural gas, well, good luck. That sell-off has been immediately met with another huge, huge pump. Yes, there's resistance. Yes, there's selling wicks. But you are staying stubbornly long at these very, very high levels in and around the 8.2. And the forward pricing for that gas in Europe, remember, a lot of this is NYMEX, New York Mercantile Exchange, not what Europeans will pay. The problem is gas don't travel easy. And the cost of liquefying it, putting it on boats and getting it over to the other side, especially with all the mischief they've made with Russia, is going to hurt bad. So all of these things say energies are going to remain firm. Market's going to be recessional and heavily recessional, no matter what they want to redefine. And this is hyper-stagflation. Contraction, contraction, contraction in terms of your growth environment. Assets deflating, deflating, deflating in our view. Cost of living's going up stubbornly high. Only on a bigger scale than the 70s, because you're far more indebted than the 70s, and we assess that you've made the top on debt market, and that in time all assets, including the debt shell game, will deflate away. That means paper gold can go down. However, you should mark it, you should take it. I'm hearing news in Spain, they want to know who owns what in all their safety deposit boxes. Make sure it's off grid, make sure it's held by you, make sure it's held safely. You're going to be dealing in a monetary system of gold and silver that the rest of the central banking cartel will not want you to own, and if you do, will want it on a clipboard and known, and then you might get a visit someday, etc., etc., maybe with a capital gains tax bill, who knows. So that's how it goes. That's our take on the precious metals. By the way, we didn't run the rack on the others. Sometimes I get guys saying, well, why don't you just give us a quick look at Palladium and some of the others. Let's also just take a quick look at the gold-silver ratio. This is actually fairly supportive in that, and I highlight here again, the gold and silver ratio. In fact, the one I like to do is actually slightly different. I like to do gold contract and and I like to divide it by the silver contract because I think we get a little bit more history in that one. Okay, you got it. So now you get a bit more history in terms of this gold-silver ratio when you do it like that, and you can see what's gone on. And I can tell you that this, apart from this was the COVID extreme event spike, which I'm not saying could never happen again beyond, because they're certainly planning some nasty business, no doubt in my mind. But generally, when you're in and around the 80s, and I'm going to drop a line on that, that is 80s for the gold-silver ratio. There we go. Here comes all our lovely, magnificent draws. Let's make it 80. I grew up in the 80s. Yep. Let's have a look. So you pop it on there. We've shown a number of times that there's actually been very little. I'll take that off for a second. Just memorize where that 80 line is. It's just below that level there. You have actually very little that's gone on where you've held above the 80s for an extended period. It's been resistance here, for example. It's been resistance here. It's been resistance here. It's been resistance here. It's been resistance those two heights. And you're getting a shooting star there, and then you had the blow off here, which was your COVID's 1984. And that's pretty much it. You don't get to smell the air that high up on Everest, and this is a shooting star. So that's slightly bullish actually on the metals, on the paper price short term. So you could, in fact, as I've said again, short term, you could improve on the paper price, but don't lose your head too much on account of those debts. You could come up and have one more blow-off moment that could bring you to a similar level on gold-silver ratio. So that's the gold-silver ratio. What else did I highlight in those annotations that you were just looking at? So I'll put the eye back on. You can see the other things I pointed out here. What I have said before is we never got a full bull market in the last one. Let's get this so that we can see the whole chart. Let's pull it over, get some history, and I will also put it on reg scale so that we can have it in the framing that we had it in. Big lengthy channel over here. That was your last weakening of gold. You were as low as 16.5. Yes, that's right, in the 80s, 16.5, all the way up to 102. Down, down, down. This was not a full bull market that you got 2011. You dropped to 30.5 when gold was 1927 and silver traded 50 again. That was not a full bull market. You never went from super overvalued down here, 16.5s. You never got to the teens, and you never got to beyond the hundreds. You touched 80. You touched 80 a few times. Here is your key level of significance, 90. You only ran that in the late 80s, turning 90. That was the weakest it was, early 90s. And then in the noughties, you were down back here as gold started to recover. So this is the gold-silver ratio. So you've only had one huge bull here of the 80s, 79, and then the weakness all the way into its worst period, which was 91. On the gold-silver ratio, 102. Since then, you pull back into this range. You had a semi-bull run, the 2011 moments, where you got to 30.5 gold to silver. Then you had this rising wedge with a pop out the top and an extreme blow-off, and then you came down. This looks like a return move that could be losing some steam. You had a major break. We've been getting stronger. We had that bull run post the COVID events on it, but then since then, we've been actually rallying up. So that's been a little bit of a lean on metals. It's been battling to hold value against the dollar for now during this semi-period post the bull market highs of 2000. So a little bit of a pullback there, but it's actually done a reasonable job of holding value. It's stayed above 1680, and silver's generally been above 18.5. So, and against the other currencies, the euro and the yen, it's absolutely serving its purpose. So the prediction for us, which is now outdated because we rallied, I haven't looked at this chart in a long, long time, would be for at some point in the future, you would actually potentially even get a single digit dip on the gold-silver ratio, which would be extremely bullish for both gold and silver. Don't forget, solar panels, the new energy system. Boy, when that thing gets properly going, that everybody is solar, they should make every Tesla owner charge a car on solar. So there was that. Then you guys also asked for the palladium and the other items. So let me finish quickly on those, and then we can call it a day on the metals run. Just running a quick look at platinum potentially, and a quick look also at palladium. Now, palladium is an interesting one because it's far harder and it's much thinner to manipulate, and you can't put this huge ass Ponzi scheme of derivatives on it. It's very much by order, and they just don't pull it out the ground on any great scale. So let's go XPD, XPD, XPD. You can see it's been really choppy, but boy, what a bull market. Boy, what a bull market. Let's switch off the news. Kind of very schizo here. Again, it suits the narrative of a bit of a downside. When people say it's getting volatile out there, it generally means there's a downside due to come in the paper markets. Now, if I put it on log scale, it doesn't look quite so volatile, but it is not a nice continuation pattern. You've had marginally higher highs on 3 levels. You've got a bit of a support here at 1724. It's a very unsettled, zippity-doo-dah day type market, a bit of a fruit fly. In that it buzzes up and down and left and right faster than you can say Jack Sparrow. But you can see generally how it's done, and what a huge bull run. Around about just above the 420s, you're at probably about 450, right the way up to 3,000. What a period to have been long. 2016, Shanghai Accord. Yes, boy, then the China was all in debt, and then it was all over. Suddenly metals running. Yup. And then, of course, as I say, there's this funny lows here and these marginally higher highs. It's a little bit of a concern for me on this monthly chart. So again, there could be scope for this to have a pullback to the downside, especially if demand is killed in manufacturing. So I don't feel you should be charging in there, and it's also done an immense amount relative to some of the others. Does my view change when you drop lower time frame? Your macro should go. I still think at long term it'll be a bull, and short term right now it's going up. So if you want to do, if you're the guy who trades 5 minute and hourly and even half daily charts, this is probably short term going to go up. I mean, you had quite a decent falling wedge structure here that is broken, and technically there'd been no harm for you if you'd taken that. But note, you get a break from the wedge, then you get a return move. It's hard to predict that. You could have got in and chased in and got flushed out on that pullback. For me, it's it's nip and tuck trading stuff that I don't feel I need to be part of that. So platinum, and then we'll finish. Platinum has not done so well. Let's go up to the monthly and let's show you. Platinum has not done so well. I think in the long run it does pretty damn well, but it's not done so well at this juncture. Big falling wedge with a dip out the bottom there, kind of a bit fat and ugly, very, very, very intense, bloated second impulse here. That was all super bloat into that low, which eventually actually you got COVID in low, making a new low, so you wicked out somewhere there. Maybe you could draw it also like that. I don't think that changes my view. You broke out of your falling wedge, but then you return moved, you tried again, and then you've been dragged down. This is heavy. It's battling to get away, but eventually it may well do. But you could also see it slip a little bit on that. Yes, on the hourly, daily period, everything is short term going up. More medium term, I'm concerned, and then longer term, I'm bull again. So 3 time frames. Short term, generally, you're going up on the hourly in the next few hours, the next few days. More medium term, I'm more concerned what happens in the next month and 6 months. Long term, what's happening over the next year, 3 year, 5 year, very bullish. Please understand time frame analysis. We are looking at a monthly chart. So the time frame analysis says macro, I see some form of move up at some point. And the minor time frame, I see it up here as well. But you could dip down one more time with those events that I'm talking about. Okay, that's it, guys. That's your precious metals update. Thanks for watching. We appreciate it if you book a call if you feel you would like to build wealth in reset times. We appreciate shares and likes. When you book that call, you'll talk to someone just like you only a few years before. Only our community members take call. They're very professional. They will show you all that we do in terms of developing wealth, trading the markets, the FX markets, and the crypto and the commodity markets in reset times. Okay, we'll catch you later. Thanks for watching, and yeah, play safe. Be cautious a bit. There's a lot of downside risk out there. Bye for now.